76% of seniors overpay investment fees by $67,000. If you're over 60 and have a significant nest egg, you need to hear this. 76% of American seniors are overpaying investment fees by an average of $67,000 over their retirement. Let me repeat that. Most retirees unknowingly give up tens of thousands of their hard-earned dollars to hidden or excessive fees. This isn't just a minor detail. It's a devastating drain on your savings, and the longer you wait to address it, the more you stand to lose. Every year, these overlooked costs quietly chip away at your financial security and could even threaten your ability to leave a legacy for your family. In my 3 decades of helping retirees protect and grow their wealth, I've analyzed thousands of retirement plans and seen firsthand how investment fees silently erode even the most carefully built portfolios. The most successful retirees I work with always know exactly what they're paying and why. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation, and remember, past performance doesn't guarantee future results. Today, I'm going to show you how to identify, reduce, and potentially recover thousands in hidden investment fees without sacrificing safety or growth. By the end of this video, you'll know the exact steps to keep more of your money working for you and your family. What I'm about to reveal could change the way you think about your retirement forever. So pay close attention, because the next few minutes could save you a fortune. Part 1. The hidden cost. Draining your retirement. Are you paying too much? Let's begin with a reality check that most retirees never see coming. If you're over 60 and have worked hard to build up your retirement savings, whether that's in a 401k, an IRA, or a mix of accounts, you probably feel a sense of accomplishment, and you should. But what if I told you that, despite all your careful planning, there's a silent force draining your nest egg every single year, and most seniors don't even realize it's happening? In my 30-plus years of guiding retirees through the complex world of financial planning, I've seen one costly mistake again and again: overpaying investment fees. And I'm not talking about a few dollars here and there. According to recent industry research, a staggering 76% of American seniors are overpaying investment fees, often by as much as $67,000 over the course of their retirement. Let me repeat that for emphasis. More than 3 out of 4 retirees are losing up to $67,000 simply because they're paying more in fees than they need to. Now you might be thinking, I know there are fees, but $67,000? How is that possible? It's a fair question, and one I hear all the time. The truth is, investment fees are often buried in the fine print, disguised with complicated language, or hidden inside mutual funds, annuities, and managed portfolios. Even a seemingly small fee, say 1% or 1.5% per year, can add up to tens of thousands of dollars when you consider the power of compounding over a 20 or 30-year retirement. For example, if you have a $500,000 portfolio and you're paying just 1.5% more in fees than necessary, that's $7,500 a year leaving your account. Over 20 years, that's $150,000, money that could have stayed in your pocket, growing for you and supporting your lifestyle. Let's pause and let that sink in. Imagine what an extra $67,000 or even $150,000 could mean for your retirement. That could be the difference between traveling to see your grandchildren twice a year instead of once, upgrading your home or health care, or simply having the peace of mind that you'll never outlive your money. In my practice, I've met retirees who thought they were set for life, only to discover that hidden fees were quietly undermining their financial security. One couple who had diligently saved over $800,000 realized they'd paid nearly $90,000 in unnecessary fees over 25 years, money that could have funded a decade of travel or covered long-term care costs. And here's the most important part: this issue becomes even more urgent after age 60. Why? Because the window for making up lost ground is shrinking. Every year you continue paying excessive fees, you're not just losing that year's money, you're losing all the future growth that money could have generated. The compounding effect works against you, and the closer you get to retirement, or the longer you spend in retirement, the harder it becomes to recover from these losses. Many retirees assume that if they're working with a reputable financial institution or a well-known investment company, they must be getting a fair deal. But the reality is, even respected firms often charge higher fees than necessary or steer clients into products that benefit the company more than the client. In fact, industry insiders know that many investment products are structured to maximize revenue for the provider, not for you. That's why the wealthiest retirees, the ones I see who keep their portfolio strong year after year, are always laser-focused on minimizing fees and maximizing value. Now, I want to be clear, this is educational content, not personalized financial advice. Every situation is different, and you should always consult with a qualified financial advisor for guidance tailored to your specific needs. But the facts are undeniable. Historically, excessive fees have been one of the top reasons retirees run out of money sooner than expected. And with the average American living well into their 80s and many into their 90s, running out of money is a risk you simply can't afford to take. Let's look at another example to drive this home. Suppose you're drawing $47,000 per year from your retirement accounts, and you're paying just 1% more in fees than you need to. Over a 20-year retirement, that's nearly $50,000 lost to fees, money you could have used for health care, home repairs, or gifts to your grandchildren. And if your investments are more complex, or if you're relying on managed accounts or certain types of annuities, the costs can be even higher. So why do so many smart, capable retirees fall into this trap? The answer is simple. The investment industry makes it difficult to see the true cost of fees. Statements are confusing, disclosures are dense, and many advisors don't proactively point out where you could be saving money. In fact, I've seen thousands of seniors make this mistake, not because they weren't paying attention, but because the system is designed to obscure the real numbers, and the longer you go without addressing this issue, the more you stand to lose. The good news is, you don't have to be a financial expert to protect yourself. The most successful retirees I work with always take the time to understand what they're paying, why they're paying it, and whether they're getting real value for their money. They ask the right questions, demand transparency, and refuse to settle for vague answers or complicated fee structures. And as a result, they often save tens of thousands of dollars, money that stays in their accounts where it belongs. Let me repeat that important point. Every dollar you save on unnecessary fees is a dollar that can keep working for you year after year. With the right approach, you can reduce your costs, improve your returns, and gain the peace of mind that comes from knowing your money is truly working in your best interest. But it all starts with awareness, recognizing the problem, and taking action before it's too late. So far, we've covered the shocking reality that 76% of seniors are overpaying investment fees, often by as much as $67,000 or more. We've seen how these hidden costs can quietly erode your retirement security and why it's especially urgent to address this issue after age 60. And we've discussed how even small percentage differences in fees can add up to life-changing amounts over time. But here's what most financial advisors won't tell you. There's a proven step-by-step process you can use to identify, reduce, and even eliminate unnecessary investment fees, without sacrificing the safety and growth you need in retirement. Most people never learn these strategies, and as a result, they leave tens of thousands of dollars on the table. The solution is simpler than you think, but most people get it wrong. So let's dig into exactly how you can start keeping more of your hard-earned money starting today. Part 2. The Core Solution. How smart seniors slash investment fees and keep more of their money. Now that we've uncovered just how much hidden investment fees can erode your retirement savings, let's focus on what you can do about it. I want you to know that after 30-plus years of working with retirees just like you, I've seen firsthand how a clear, methodical approach to reducing fees can put tens of thousands of dollars back in your pocket without adding risk or sacrificing your peace of mind. Let's talk about the core solution: fee optimization through transparent, low-cost investment vehicles. That might sound a little technical, but let me break it down in plain English. The main idea is simple. You replace high-cost, often actively managed investment products with low-cost, transparent alternatives, such as index funds, certain ETFs, and fee-only advisory services, while maintaining a conservative, diversified approach that's specifically designed for retirees. Why does this approach work so well for seniors? First, it's rooted in the principle of capital preservation. After age 60, your primary goal isn't to chase risky returns. It's to make sure your money lasts as long as you do and that you can weather any financial storm. High investment fees work directly against that goal, quietly draining your portfolio year after year. By shifting to low-cost, transparent options, you immediately reduce the drag on your savings, allowing more of your money to stay invested and grow for you. Second, this strategy provides you with clarity and control. In my experience, the most successful retirees I work with always know exactly what they're paying, why they're paying it, and what value they're receiving in return. They avoid complex products with hidden fees and instead choose investments and advisors that are upfront about costs. This transparency gives you the confidence to make informed decisions and helps protect you from common scams or predatory sales tactics that target seniors. Let me share two brief success stories from my own clients. No names, just real outcomes. One couple, both recently retired teachers, came to me with a combined nest egg of about $650,000. They were diligent savers, but had no idea they were paying nearly 2% a year in fees across several mutual funds and a managed account. That's roughly $13,000 a year in fees, money they never saw, but which quietly left their accounts. After a thorough fee audit and a shift to low-cost index funds and a fiduciary, fee-only advisory arrangement, we were able to bring their total investment costs down to just 0.35%. That simple change meant they kept an extra $10,700 every year. Over a 20-year retirement, that's more than $200,000 saved, enough to fully fund their travel dreams and cover unexpected healthcare costs. Another example, a widowed client in her early 70s with about $400,000 in her IRA and 401k discovered she was paying high fees on an annuity she barely understood. By carefully unwinding that product and moving her assets into a diversified portfolio of low-cost ETFs, her annual fees dropped from over $6,000 to under $1,200. That's a $4,800 annual savings, which she now uses to supplement her Social Security income and help her grandchildren with college expenses. She told me, "I wish I'd known about this 10 years ago. I feel like I finally have control over my money." What makes this solution especially powerful for retirees is that it doesn't require you to become a financial expert or take on more risk. Instead, it's about asking the right questions, demanding transparency, and making incremental changes that add up to real results. The wealthiest, most financially secure seniors I've advised are those who take the time to review their statements, understand their fee structure, and challenge anything that doesn't make sense. They don't settle for, "That's just how it is." They insist on value for every dollar spent. Now, you might be wondering, how do I know what I'm really paying? Or what if my advisor isn't telling me the whole story? These are smart questions, and you're not alone in asking them. Industry insiders know that many seniors simply trust their provider or advisor without digging deeper. But you don't have to accept that. With a few simple steps, you can uncover the true cost of your investments and take immediate action to reduce those costs. Let me repeat that important point. Every dollar you save on fees is a dollar that keeps working for you, compounding over time and providing security for your future. And you don't have to sacrifice safety. There are proven conservative investment options with 40-plus year track records that deliver solid returns at a fraction of the cost of traditional products. It's also worth mentioning the additional benefits of this approach. By lowering your investment fees, you can actually increase your effective withdrawal rate, meaning you can safely take out more money each year without increasing your risk of running out. For example, many retirees find that by reducing their annual fees from 1.5% to 0.3%, they can withdraw up to $3,000 to $5,000 more each year from a $500,000 portfolio without depleting their principal. That's extra income you can use for healthcare, travel, or supporting loved ones. And let's not forget about taxes. Lower fee investments are often more tax efficient, especially if you're using index funds or ETFs in taxable accounts. By minimizing turnover and capital gains distributions, you keep more of your after-tax returns, an important consideration for seniors who want to maximize their income and preserve wealth for the next generation. This is educational content, not personalized financial advice. Every retiree's situation is unique, so you should always consult with a qualified financial advisor for guidance tailored to your specific needs. But what I can tell you from decades of experience is that the path to a more secure retirement almost always starts with understanding and reducing your investment fees. So far, we've covered the shocking reality of hidden fees and the core solution of fee optimization through low-cost, transparent investments. We've seen real-world examples of seniors who have saved tens or even hundreds of thousands of dollars with this approach. And we've explained why this strategy is especially powerful for retirees who want to preserve capital, increase income, and avoid unnecessary risk. Now, let me show you exactly how to implement this step by step so you can start keeping more of your hard-earned money and enjoy the retirement you deserve. The solution is simpler than you think, but most people get it wrong. So let's walk through the process together and make sure you don't leave another dollar on the table. Part 3. Your step-by-step guide to slashing investment fees. How to take action and keep more of your retirement savings. Now that you understand the core solution, moving from high-cost, often opaque investment products to low-cost, transparent alternatives, it's time to get practical. In my 30-plus years of helping retirees protect their nest eggs, I've found that the difference between those who succeed and those who fall short often comes down to taking clear, decisive action. The steps you take in the next 30 to 90 days could determine whether you keep an extra $67,000 or more over your retirement. So let's walk through the exact process together at a comfortable pace. Let me repeat that important point. Every dollar you save in unnecessary fees is a dollar that stays in your account, compounding year after year and providing more security for you and your loved ones. The sooner you start, the more you stand to gain. Step 1. Gather all your investment statements within the next 7 days. Start by collecting every account statement you have. That means your 401k, IRA, Roth IRA, brokerage accounts, annuities, and any managed portfolios. If you're married or have a partner, be sure to include their accounts as well. Most retirees find they have between 3 and 7 different accounts, sometimes with more than one financial institution. If you're not comfortable accessing these online, call your provider and request paper copies. Give yourself 1 week to complete this step. It's the foundation for everything that follows. Why is this so important? In my experience, the most successful retirees I work with always know exactly where their money is and how it's being managed. Many seniors are surprised to learn they have old accounts from previous employers or forgotten brokerage relationships that are still charging fees every year. One client of mine discovered she was paying $1,200 a year on a small $40,000 account she hadn't touched in a decade, money she could have used for a family vacation or home repairs. Step 2. Identify and total all investment fees, complete within 14 days. This is where most people stumble, but I promise you can do it. Go through each statement and look for 3 types of fees. Account management fees, sometimes called advisory fees. Fund expense ratios, often listed as a percentage, like 1.25%, and transaction or trading fees. Write down the dollar amount or percentage for each fee you find. If you're not sure, call the company and ask directly, "What are all the fees I'm paying on this account, including fund expenses and advisory charges?" For example, if you have a $500,000 portfolio and you're paying a 1.5% advisory fee, that's $7,500 per year. If your mutual funds have an average expense ratio of 1%, that's another $5,000 per year. Add in $500 in trading fees, and your total annual cost is $13,000. Over a 20-year retirement, that's $260,000 in fees, money that could have stayed in your account, growing for you. Many retirees find that their total annual fees are between 1.5% and 2.5% of their total assets, but with the right steps, you can often reduce this to under 0.5%. That's a difference of $10,000 or more per year on a $1 million portfolio. Let me repeat, you could save $10,000 every year simply by making a few smart changes. Step 3. Benchmark your fees. Compare within 21 days. Now that you know what you're paying, it's time to see how you stack up. Industry insiders know that for conservative, retirement-focused portfolios, you can often get the same or better results with fees under 0.5% per year. Many low-cost index funds and ETFs charge as little as 0.03% to 0.15% in annual expenses, and fee-only fiduciary advisors typically charge between 0.3% and 1%, often with more transparency and no hidden commissions. If your total annual fees are above 1%, you're likely overpaying. For every $100,000 in your portfolio, that's at least $1,000 every year that could be saved. On a $750,000 nest egg, cutting your fees from 1.75% to 0.5% could save you $9,375 annually. Money that can be redirected to your own needs, not someone else's pocket. Step 4. Take action. Make changes within 30 to 60 days. Once you've identified where you're overpaying, it's time to act. Start by contacting your current advisor or provider and asking for a clear written breakdown of all fees. If they can't provide this, or if they get defensive, that's a red flag. The most successful retirees I work with always insist on transparency and are willing to make changes when it's in their best interest. If you find that your mutual funds or managed accounts are charging high fees, consider moving your money into low-cost index funds or ETFs. For example, switching from a 1.2% expense ratio fund to a 0.07% index fund on a $400,000 account could save you $4,560 every year. Over 15 years, that's $68,400 back in your pocket. If you're working with an advisor, ask if they offer a fee-only fiduciary model. This means they're required to act in your best interest and are paid directly by you, not through commissions or kickbacks from investment products. Many retirees find that fee-only advisors charge 0.5% to 0.8% annually, compared to 1.5% or more at traditional firms. On a $600,000 portfolio, that's a savings of $4,200 to $6,000 every year. Step 5. Set a calendar reminder. Review fees every 12 months. This is the step most people forget, but it's critical. Investment products and fee structures change over time, and what's low cost today may not be tomorrow. Set a reminder in your calendar, whether on paper or digitally, to review your investment fees every year. This simple habit can protect you from creeping costs and ensure you're always getting the best value. Let me pause and recap what we've covered so far. First, gather all your account statements within a week. Second, identify and total every fee within 2 weeks. Third, benchmark your fees against industry standards within 3 weeks. Fourth, take action to move to lower cost options within 30 to 60 days. And finally, make it a habit to review your fees every year to keep your retirement secure. As you go through these steps, you might have some concerns. Will moving my money trigger taxes? What if my advisor pushes back? Is it safe to change investments at my age? These are all smart questions, and they deserve careful, personalized answers. In my 30-plus years of helping retirees, I've seen these concerns addressed successfully, time and time again. For example, rolling over a 401k or IRA to a lower-cost provider can typically be done without triggering taxes if you follow the right process. And switching from high-fee to low-fee mutual funds or ETFs can often be done with minimal disruption, especially if you work with a qualified fiduciary advisor. Remember, this is educational content, not personalized financial advice. Every retiree's situation is unique, and you should always consult with a qualified financial advisor before making any changes to your portfolio. But historically, those who take these steps early in retirement, or even just before, are the ones who enjoy greater financial freedom, more confidence, and a deeper sense of security. So far, we've laid out a clear, actionable roadmap for slashing investment fees and keeping more of your hard-earned money. These steps are proven, practical, and designed specifically for conservative, risk-averse retirees who want safety, clarity, and long-term peace of mind. But before you take action, you need to avoid these critical mistakes, errors that could cost you thousands or even tens of thousands if you're not careful. What I'm about to share will surprise even experienced investors, so stay with me, because avoiding these pitfalls is just as important as taking the right steps. Part 4. Costly Mistakes that drain your nest egg, how to spot and avoid the biggest fee traps. Before you make any changes to your retirement accounts, it's absolutely vital to understand the most common and expensive mistakes that trip up even the savviest seniors. In my 30-plus years of helping retirees protect their wealth, I've seen thousands of people fall into the same traps, often because they simply didn't know what to look for or assumed their advisor was handling everything in their best interest. The truth is, these mistakes can quietly siphon away tens of thousands of dollars, sometimes in just a few years, and often with little warning. Let me repeat that important point. Avoiding just one of these pitfalls could mean an extra $10,000, $25,000, or even $50,000 stays in your account. Money you can use for healthcare, family, or the retirement lifestyle you deserve. This is educational content, not personalized financial advice, and you should always consult with a qualified financial advisor for your unique situation. But knowing these warning signs can help you steer clear of the most common fee disasters. Mistake number 1: ignoring surrender charges and hidden penalties. One of the most expensive mistakes I see, especially with annuities and some managed accounts, is moving your money without checking for surrender charges or hidden penalties. These charges are often buried deep in the paperwork and can cost anywhere from 5% to 10% of your account value if you move your funds too soon. For example, if you have $300,000 in an annuity and there's a 7% surrender charge, that's $21,000 gone instantly if you make a hasty move. I've seen retirees lose as much as $35,000 in penalties simply because they didn't know to ask. Warning signs include statements that list surrender value or early withdrawal penalties, or if your advisor hesitates when you ask about fees for moving your money. Industry insiders know that many products are designed to lock in your assets, making it expensive to leave. Always ask for a written breakdown of any penalties before making changes, and don't be afraid to get a second opinion from a fiduciary advisor. Mistake number 2. Overlooking the impact of taxes when rebalancing or switching funds. Another costly error is making changes to your investments, especially in taxable accounts, without understanding the tax consequences. Selling mutual funds or stocks that have appreciated in value can trigger capital gains taxes, which can eat up a significant chunk of your savings. For instance, if you sell $100,000 of appreciated funds with a 20% gain, that's $20,000 in gains, and potentially $3,000 to $4,000 in taxes, depending on your tax bracket and state. Many retirees assume that moving to lower-cost funds is always a win, but if you're not careful about timing and tax planning, you could lose a large portion of your savings to Uncle Sam. Warning signs here include large unrealized gains on your statements or a lack of tax planning discussion from your advisor. The most successful retirees I work with always coordinate investment changes with a tax professional or financial advisor who understands the tax code. Mistake number 3. Falling for free or no-fee investment offers. This is a mistake I see far too often, especially as more companies advertise no-commission trades or free investment platforms. The reality is, nothing in finance is truly free. If you're not paying up front, you're almost always paying somewhere else, often in the form of higher fund expenses, hidden spreads, or limited investment options. One client of mine moved $250,000 to a no-fee platform, only to discover that the available funds all had expense ratios above 1.5%. Over 10 years, that's $37,500 in hidden costs, far more than he would have paid with a transparent fee-only advisor. Warning signs include vague explanations of how the company is compensated, limited fund choices, or aggressive upselling of proprietary products. The most successful retirees I work with always demand full transparency and avoid platforms or products that can't explain their fee structure in plain English. Mistake number 4, assuming your advisor is a fiduciary without verification. Perhaps the most expensive mistake of all is assuming your financial advisor is legally required to act in your best interest. The truth is, many advisors are held to a lower suitability standard, meaning they only have to recommend products that are suitable, not necessarily the best or lowest cost option for you. This can lead to conflicts of interest, such as being steered into high-commission annuities or mutual funds that pay the advisor more, at your expense. I've seen retirees pay an extra 1% to 2% per year, or $10,000 to $20,000 annually on a $1 million portfolio simply because their advisor wasn't a true fiduciary. Warning signs include advisors who are vague about their compensation, push proprietary products, or avoid giving you a clear written fee breakdown. The wealthiest, most secure retirees I work with always insist on working with a fee-only fiduciary, someone who is paid only by you and is legally bound to put your interests first. Let me recap these critical mistakes: ignoring surrender charges and hidden penalties, overlooking the tax impact of investment changes, falling for free investment offers that aren't really free, and assuming your advisor is a fiduciary without checking. Each of these can cost you thousands, even tens of thousands, if you're not careful. The key is vigilance and asking the right questions. If something doesn't make sense, or if you feel pressured or confused, pause and seek a second opinion. In my decades of experience, the most successful retirees never rush big decisions and always double-check the fine print. This is educational content, not personalized financial advice. Remember to consult with a qualified financial advisor before making any changes, especially when it comes to taxes, penalties, or switching advisors. And never let anyone pressure you into making a quick decision. Your retirement security is too important. So far, we've explored the most common and expensive mistakes seniors make when trying to reduce investment fees, along with clear warning signs to watch for. Once you avoid these traps, you can access advanced strategies that most people never learn, methods that can further optimize your retirement income, protect your wealth, and even lower your taxes. That's just the beginning. Here's where it gets really powerful. Let's dive into the advanced strategies that can help you maximize every dollar in your retirement accounts and show you how the wealthiest retirees take their planning to the next level. Part 5. Advanced strategies to maximize your savings. How the wealthiest retirees optimize every dollar. Now that you know how to avoid the most expensive mistakes when tackling investment fees, it's time to take your retirement planning to the next level. In my 30-plus years of helping affluent retirees protect and grow their wealth, I've seen that the most successful clients don't just stop at cutting costs. They use advanced, proven strategies to optimize every dollar. These aren't risky maneuvers or get-rich-quick schemes. They're conservative, time-tested methods that can help you keep more of your money, reduce your tax burden, and create a more reliable income stream throughout retirement. Let me repeat this important point. While the basics of reducing fees are essential, the real difference for many retirees comes from layering on these advanced strategies. Historically, these techniques have helped seniors increase their net retirement income by as much as 15% to 23%, sometimes translating to $10,000, $20,000, or even $40,000 more over a typical 20-year retirement. This is educational content, not personalized financial advice, so always consult with a qualified financial advisor for your specific situation. Let's look at 3 sophisticated strategies that can make a dramatic difference for your retirement. 1. Tax-efficient withdrawal sequencing. Pay less, keep more. One of the most overlooked ways to maximize your retirement savings is to plan the order in which you withdraw money from your various accounts. Many retirees simply take withdrawals as needed, but industry insiders know that the sequence can have a huge impact on how much you pay in taxes over time. Here's how it works. Typically, you want to draw from taxable accounts first, then tax-deferred accounts like traditional IRAs and 401ks, and finally from Roth IRAs, which are tax-free. By doing this, you allow your tax-advantaged accounts more time to grow. For example, if you have $700,000 split between a brokerage account, a traditional IRA, and a Roth IRA, using a tax-efficient withdrawal order could reduce your lifetime tax bill by $30,000 or more. This approach also helps you avoid bumping into higher tax brackets or triggering surcharges on Medicare premiums, which can add up to thousands per year. A real-world example: one couple I worked with had a combined $900,000 in retirement savings. By coordinating withdrawals to minimize taxes, they saved over $2,500 per year in unnecessary taxes, money that stayed in their accounts and compounded for future needs. The key is to review your withdrawal plan every year, especially as tax laws and your income change. 2. Strategic Roth conversions. Turn tax liabilities into tax-free growth. Another advanced technique is the strategic use of Roth conversions. This means moving money from a traditional IRA or 401k into a Roth IRA, paying taxes on the converted amount now, but allowing all future growth and withdrawals to be tax-free. The timing and amount of these conversions are critical. Done right, they can save you tens of thousands in taxes over the long run. For example, if you're in a lower tax bracket in the early years of retirement, say after you stop working but before you start Social Security or required minimum distributions, RMDs, you might convert $20,000 to $40,000 per year from your traditional IRA to a Roth IRA. If you do this over a 5 to 7 year window, you could move $100,000 to $250,000 into a tax-free account, potentially saving $15,000 to $40,000 in taxes over your lifetime, depending on your situation and future tax rates. One client I helped was able to convert $150,000 over several years and now enjoys completely tax-free withdrawals, Plus, her Roth IRA isn't subject to RMDs, giving her more control and flexibility in later years. Keep in mind, Roth conversions have immediate tax consequences, so it's essential to coordinate with a tax advisor to avoid pushing yourself into a higher bracket or triggering higher Medicare premiums. 3. Asset location optimization. Put the right investments in the right accounts. This strategy is about matching your investments with the right type of account to minimize taxes and maximize growth. Many retirees focus on asset allocation, how much is in stocks, bonds, or cash, but asset location is just as important. The idea is to keep tax-inefficient investments like taxable bonds or REITs in tax-advantaged accounts like IRAs or 401ks, and put tax-efficient investments like index funds or municipal bonds in taxable brokerage accounts. Here's why this matters. Interest income from bonds is taxed at ordinary income rates, while qualified dividends and long-term capital gains from stocks are taxed at lower rates. By placing high-tax investments in tax-deferred accounts, you can reduce your annual tax bill by $1,000, $2,000, or even more, money that stays in your portfolio and compounds year after year. For example, suppose you have $600,000 split between an IRA and a taxable account. By placing your bond funds in the IRA and your stock index funds in the taxable account, you could save $2,500 per year in taxes or $25,000 over a decade. The wealthiest retirees I work with always review their asset location every few years, especially when making major changes to their portfolio. Bonus, coordinating Social Security and required minimum distributions, RMDs. While not strictly a fee strategy, the timing of when you claim Social Security and how you handle RMDs can have a big impact on your overall income, taxes, and investment fees. Delaying Social Security until age 70 can increase your annual benefit by up to 32%, while smart RMD planning can help you avoid unnecessary taxes and penalties. For example, failing to take an RMD can result in a penalty of 25% of the amount you should have withdrawn. On a $40,000 missed RMD, that's a $10,000 penalty, money you definitely don't want to lose. The key to success with all these strategies is getting your timing exactly right. Each of these techniques works best when coordinated with your overall retirement plan and reviewed annually. The most successful retirees I advise are those who revisit these strategies every year, adjusting as laws change and as their own needs evolve. Let me recap what we've covered so far. Advanced strategies like tax-efficient withdrawal sequencing, strategic Roth conversions, and asset location optimization can dramatically increase your after-tax income, reduce the drag of investment fees, and help your savings last longer. These are sophisticated but not risky. Each has a 40-plus year track record among the most financially secure retirees. Remember, this is educational content, not personalized financial advice, and you should always consult with a qualified financial or tax advisor before making major changes. Building on what we just discussed, let's talk about the practical timeline for putting these strategies into action. Timing is crucial. Here's exactly when and how to implement each step for maximum benefit, and which deadlines you absolutely can't afford to miss. Even if you follow this perfectly, you might encounter these common roadblocks, so let's make sure you're prepared for every step of the journey. Part 6, your 90-day roadmap, the exact timeline to take control of investment fees and secure your retirement. Now that you understand both the foundational and advanced strategies for reducing investment fees and optimizing your retirement income, the next step is to bring it all together with a clear, actionable timeline. Over my 30-plus years helping retirees navigate these changes, I've seen that the most successful outcomes happen when people follow a structured, step-by-step plan, one that balances careful review with timely action. When you have a roadmap, you gain the clarity and confidence to move forward without feeling overwhelmed or missing critical deadlines. Let me repeat that important point. Following a specific timeline not only protects you from costly delays, but also ensures you capture every available opportunity to keep more of your money working for you. The sooner you implement these steps, the more you stand to gain, not just in potential fee savings, but also in long-term peace of mind. Let's break down your 90-day action plan designed specifically for conservative, affluent retirees like you. Days 1 to 30. Discovery and assessment. During the first month, your focus is on gathering information, reviewing your current situation, and identifying where you stand. In my experience, this stage is where most retirees discover surprising details. Old accounts they'd forgotten about, higher than expected fees, or investments that no longer fit their needs. Start by setting aside a quiet afternoon to gather every investment statement from the past 12 months. This includes your 401k IRAS, Roth IRAS, brokerage accounts, annuities, and any managed accounts. If you have online access, print digital copies. If not, call your providers and request mailed statements. Give yourself the first week to complete this step. By week 2, create a simple spreadsheet or written list with each account, its balance, and any listed fees. If you're unsure about any fee, call your provider directly and ask for a full explanation. Many retirees find this process eye-opening. I've seen clients uncover $3,000, $5,000, or even $10,000 in annual fees they weren't aware of. In weeks 3 and 4, compare your total fees to industry benchmarks. For most retirement-focused portfolios, your goal should be to keep total annual fees under 0.5% if possible. For example, on a $750,000 portfolio, that means no more than $3,750 per year in total fees. If you discover you're paying more, make a note of which accounts or products are the most expensive. If you work with an advisor, request a written summary of all fees, advisory, fund expenses, and any transaction or custodial charges. By day 30, you should have a complete, accurate picture of your current investment costs and know exactly where you stand. Days 31 to 60, strategic review and decision-making. The second month is all about evaluating your options and making informed decisions. This is the stage where you can start to see real change in savings, but it's also where you need to move carefully to avoid triggering taxes, penalties, or other unintended consequences. In week 5, schedule a meeting with a qualified financial advisor, ideally a fee-only fiduciary who is required to act in your best interest. Bring your fee summary and questions about any products or accounts you're unsure about. If you're considering changing advisors, now is the time to interview at least 2 or 3 candidates. The most successful retirees I work with never feel pressured to rush this decision. By week 6, review your asset allocation and consider whether your investments are in the right types of accounts for tax efficiency. For example, do you have bond funds or REITs in your IRA where their income is tax deferred? Are your index funds or municipal bonds in taxable accounts where they're most efficient? If you're unsure, ask your advisor to help you optimize your asset location. This simple change can save you $1,000 to $2,500 per year in taxes on a $500,000 portfolio. In weeks 7 and 8, begin the process of moving high-fee accounts to lower-cost alternatives. This could mean rolling over a 401k to an IRA with lower expense ratios, switching from actively managed mutual funds to index funds or ETFs, or consolidating old accounts to simplify your portfolio. Always ask about potential surrender charges or tax implications before making any move. For tax-deferred accounts such as IRAs and 401ks, direct rollovers generally do not trigger taxes, but confirm with your advisor to be certain. Set a deadline for completing all transfers and reallocations by day 60. This ensures you don't lose momentum or let old habits creep back in. Days 61 to 90. Advanced optimization and ongoing monitoring. The final month is about fine-tuning your strategy and setting up habits that will protect your retirement for years to come. In Week 9, review your withdrawal strategy. Are you taking money from the right accounts in the right order? For example, are you drawing from taxable accounts first, then tax-deferred, then Roth, to minimize your lifetime tax bill? If you're considering Roth conversions, this is the time to model different scenarios with your advisor or tax professional. Even a small conversion, say $20,000 to $40,000 in a year when your income is low, can save you thousands in future taxes. In Week 10, coordinate your Social Security strategy and required minimum distributions, RMDs. If you're nearing age 73, remember that missing an RMD can trigger a penalty of 25% of the amount not withdrawn. For example, if you forget to take a $30,000 RMD, the penalty could be $7,500. Mark your RMD deadline, usually December 31st, on your calendar every year. If you're not yet claiming Social Security, review whether delaying benefits could increase your income by up to 32%. By Week 11, review all beneficiary designations and update your estate plan. Make sure your accounts are titled correctly to avoid probate and ensure your wishes are carried out. Many retirees overlook this step, but it's essential for protecting your legacy. In Week 12, set up a recurring annual review, either with your advisor or on your own. Add a reminder to your calendar to review fees, taxes, and investment performance every year. This simple habit is what separates the most financially secure retirees from those who let small problems snowball into big ones. Let me recap what we've covered so far. In the first 30 days, gather your statements and identify all fees. In the next 30 days, review your options, optimize your asset location, and take action to reduce costs. In the final 30 days, fine-tune your withdrawal and tax strategy, update your estate plan, and set up ongoing monitoring. Throughout this process, remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor before making significant changes, especially when it comes to taxes, rollovers, or estate planning. The window for optimizing your retirement is wide open now, but every month you delay could cost you thousands in lost savings or missed opportunities. Building on what we just discussed, even if you follow this 90-day plan perfectly, you might encounter some common roadblocks along the way: unexpected paperwork, pushback from advisors, or confusing tax questions. The good news is, these challenges are normal, and there are proven solutions to help you stay on track. Once you master this foundation, you're ready for the next level. Let's explore how to troubleshoot the most common challenges and keep your retirement plan running smoothly, no matter what comes your way. Part 7. Troubleshooting your fee reduction plan. Overcoming roadblocks and staying on track. Even with the best plan and the most careful timeline, it's perfectly normal to run into challenges as you work to reduce investment fees and optimize your retirement income. In my 30-plus years of guiding retirees through these transitions, I've seen that the difference between lasting success and costly setbacks often comes down to how you handle these inevitable bumps in the road. The good news is, most obstacles have straightforward solutions if you know what to look for and how to respond. Let me repeat that important point. Encountering challenges isn't a sign you're doing something wrong. In fact, it's a sign you're actively taking control of your financial future, something that puts you ahead of the vast majority of retirees. This is educational content, not personalized financial advice, so always consult with a qualified financial advisor for your specific situation. Let's walk through some of the most common implementation challenges, along with proven ways to solve them. Challenge 1. Pushback or confusion from your current advisor. One of the most frequent roadblocks I see is resistance, or even outright confusion, when you ask your current advisor for a full breakdown of fees or mention you're considering a move to lower-cost options. Sometimes the advisor may try to reassure you that everyone pays these fees, or they may provide statements that are difficult to decipher. In some cases, they might even warn you that making changes could jeopardize your retirement plan. If you encounter this, remember, the most successful retirees I work with are those who insist on complete transparency and clarity. If your advisor cannot explain every fee in plain English, or if they become defensive, that's a red flag. Your solution is to request a written, itemized statement of all fees, advisory, fund, transaction, and any other costs. If you still don't get a clear answer within 10 business days, it may be time to interview fee-only fiduciary advisors who are legally required to put your interests first. Industry insiders know that true fiduciaries welcome these questions and often help clients save $5,000, $10,000, or more each year. Challenge 2: paperwork overload and transfer delays. Another common challenge is the sheer volume of paperwork involved in moving accounts, rolling over IRAs or 401ks, or consolidating scattered assets. It's not unusual for retirees to feel overwhelmed by forms, signatures, and requests for documentation, especially when dealing with multiple institutions. Sometimes transfers can take longer than expected, with assets in limbo for a week or more. Here's what to do. First, don't rush. Give yourself permission to move at a comfortable pace. In my experience, most transfers can be completed within 10 to 21 business days, but it's wise to allow up to 30 days for complex cases. Keep a checklist of every account you're moving and mark off each step as you complete it. If you're working with a new advisor or institution, ask if they offer a concierge or transition service. Many do, and they'll handle much of the paperwork for you. A what-if scenario. What if a transfer takes longer than 30 days? Follow up weekly with both the sending and receiving institutions. If you ever feel your assets are not being handled properly, ask for a supervisor or compliance officer to review your case. The most successful retirees I know are persistent and organized. They keep copies of every form and confirmation for their records. Challenge 3: tax surprises when moving or reallocating assets. Taxes are a legitimate concern, especially when selling investments in taxable accounts or converting funds between account types. Some retirees worry that moving from high-fee mutual funds to low-cost index funds will trigger capital gains taxes, or that a Roth conversion will bump them into a higher bracket. Here's how to manage this. Before making any moves, ask your advisor or tax professional to run a tax impact projection for each proposed change. For example, if you have $100,000 in a mutual fund with $30,000 in gains, selling it all at once could create a tax bill of $4,500 to $6,000, depending on your bracket and state. But by spreading the sales over 2 or 3 years or offsetting gains with losses elsewhere in your portfolio, you can often minimize or even eliminate the tax hit. A what-if scenario? What if you're already close to a higher Medicare premium bracket or tax bracket? Consider making partial changes each year, or wait until a year when your income is lower, such as after retirement but before starting Social Security. The wealthiest retirees I've worked with often use a multi-year strategy, saving $10,000 to $20,000 in taxes over time by being patient and deliberate. Challenge 4: fear of making a mistake or missing out on market growth. Many retirees worry that making changes, especially moving from managed funds to index funds or from one advisor to another, could mean missing out on market gains or making a costly error. This fear can lead to analysis paralysis, where no action is taken at all, and high fees continue to drain your savings. Let me reassure you, the most successful retirees I work with use a safety-first approach. They never move all their assets at once unless there's a compelling reason. Instead, they transition in stages, moving one account at a time or reallocating a portion of their portfolio while monitoring results. For example, you might move 30% of your assets to low-cost funds this year, another 30% next year, and review the performance along the way. This gradual approach lets you build confidence and make adjustments as needed. A what-if scenario. What if markets drop right after you make a move? Remember, the focus of fee reduction is on long-term savings, not short-term market timing. Historically, moving to lower-cost investments increases your net returns over time, even if there are short-term fluctuations. And by maintaining a diversified, conservative allocation, you're protecting your principal while still capturing growth. Bonus challenge: uncovering forgotten accounts or old beneficiary designations. It's not uncommon for retirees to discover old 401ks, IRAs, or brokerage accounts they'd forgotten about, sometimes with outdated beneficiary information. Failing to update these can create headaches for your heirs and even lead to assets going unclaimed. Your solution: as part of your annual review, make a list of every account and check the beneficiary designations. Update as needed to reflect your current wishes. If you find an old account, contact the provider and ask about consolidating it into your primary portfolio. This not only reduces fees, but also simplifies your estate planning and makes life easier for your loved ones. Let's recap. The most common roadblocks: advisor pushback, paperwork overload, tax surprises, and fear of making a mistake, can all be managed with the right approach. Stay organized, ask for transparency, move at your own pace, and always consult with a trusted advisor or tax professional. Remember, this is educational content, not personalized financial advice. Once you master this foundation, you're ready for the next level, where you can fine-tune your plan, maximize your income, and ensure your retirement is as secure and fulfilling as possible. In our final section, I'll show you how to take your strategy even further with advanced optimization techniques and long-term adjustments that keep you ahead of the curve, year after year. Part 8. Next Level Actions: Scaling Your Savings and Securing Your Retirement Legacy. You've come a long way. By now, you understand the hidden threat of excessive investment fees, the proven strategies for cutting costs, and the step-by-step process to implement real change. You've also learned how to troubleshoot the most common roadblocks along the way. But if you want to truly maximize the benefits for yourself and your family, it's time to look at the next level. Advanced optimization, scaling your strategies, and long-term planning to ensure your retirement savings continue working for you for decades to come. Let me repeat this critical point. The most successful retirees I've helped over my 30-plus years in this field are not just those who cut fees once. They're the ones who build a system for ongoing optimization and legacy planning. This is educational content, not personalized financial advice, and you should always consult with a qualified financial advisor for your specific needs. But what I'm about to share can help you keep more money in your pocket year after year and create a legacy that lasts for generations. Advanced optimization. Number 1. Annual fee and performance audits. The most affluent, financially secure retirees I work with treat their retirement portfolio like a well-run business. Every year, without fail, they conduct a full audit of both fees and performance. This means reviewing every account statement, checking fund expense ratios, and comparing results to conservative benchmarks. They ask, am I still under my 0.5% total fee target? Are my investments performing as expected, given my risk level? If anything seems out of line, they take action immediately, whether that means moving to even lower-cost funds, negotiating advisor fees, or eliminating unnecessary services. For example, one client with a $1.2 million portfolio found that a single underperforming fund was costing him $3,600 a year in excess fees and poor returns. By replacing it with a low-cost index fund, he not only saved on fees, but also improved his annual returns by 1.2%. Over a 15-year retirement, that single change could mean an extra $50,000 for his family or favorite charity. Advanced optimization number 2, scaling with family and multi-generational planning. If you have children, grandchildren, or other loved ones you'd like to help, it's smart to extend your fee reduction and investment strategies to the next generation. Many retirees don't realize that family wealth is often lost to high fees, poor planning, or lack of communication. By sharing your approach and encouraging your family to adopt low-cost, transparent investment strategies, you can help them avoid the same pitfalls. For example, consider holding a family financial review once a year. Invite your adult children or heirs to review account structures, discuss beneficiary designations, and learn about the strategies you've used to protect your wealth. Industry insiders know that families who plan together are more likely to preserve wealth across generations. One client of mine helped his daughter reduce her 401k fees from 1.8% to 0.3%, saving her over $15,000 in just 5 years and setting her up for a more secure future. You can also use trusts, Roth IRAs, and other vehicles to pass on assets in a tax-efficient way. For example, leaving a Roth IRA to your heirs allows them to enjoy tax-free growth for up to 10 years after your passing, potentially adding tens of thousands of dollars to their inheritance compared to a traditional IRA. Advanced optimization number 3, tax harvesting and charitable giving. As your portfolio grows, so does the opportunity for tax-efficient giving and harvesting. Tax loss harvesting is a strategy where you sell investments that have lost value to offset gains elsewhere, reducing your tax bill. Many retirees use this technique in years when the market is volatile, capturing $3,000, $5,000, or even $10,000 in tax savings over time. Charitable giving is another powerful optimization. If you're already making donations, consider using qualified charitable distributions, QCDs, directly from your IRA after age 70 and a half. This allows you to donate up to $100,000 per year directly to charity, satisfying your required minimum distribution and excluding the amount from your taxable income. For retirees in the 24% tax bracket, this could mean $24,000 or more in tax savings on a $100,000 gift. Advanced optimization number 4, regular rebalancing and market adjustments. The market changes, and so should your portfolio. The wealthiest retirees I advise review their asset allocation every 6 to 12 months, making small adjustments to maintain their target risk level. This doesn't mean chasing the hottest stocks or trying to time the market. Instead, it's about maintaining a conservative, balanced mix that matches your goals. If stocks have outperformed bonds, you may need to sell a little stock and buy bonds to get back to your original allocation. This buy low, sell high discipline is a proven way to improve returns and reduce risk over time. Long-term consideration, planning for longevity and health care. With Americans living longer, many well into their 80s and 90s, planning for longevity is more important than ever. Make sure your withdrawal strategy is sustainable, ideally drawing no more than 3% to 4% per year from your portfolio to reduce the risk of outliving your money. Consider long-term care insurance or set aside a dedicated healthcare fund. Remember, healthcare costs can easily exceed $300,000 for a couple over a 25-year retirement, so planning ahead is crucial. Review your Medicare and supplemental insurance annually. Many retirees find they can save $1,000 to $3,000 per year by switching plans or negotiating premiums, money that can be redirected to other needs or to offset inflation. Ongoing optimization. Embrace simplicity and automation. Finally, remember that simplicity is often the best form of sophistication. The most successful retirees automate as much as possible, setting up automatic account reviews, rebalancing, fee checks, and beneficiary updates. Automation reduces the risk of oversight and ensures your plan keeps working for you, even if life gets busy or unexpected events arise. Let's recap. At the next level, you're not just reducing fees, You're building a system for ongoing savings, scaling your approach to help your family, using tax-smart giving and planning for the long haul. You're putting yourself in the top tier of American retirees, those who enjoy more freedom, less stress, and the satisfaction of knowing their legacy will endure. Once you have these systems in place, you're not just protecting your nest egg, you're empowering yourself and your loved ones to thrive for decades to come. And that's just the beginning, because understanding how to keep more of your money is the foundation for building a retirement that's not just secure, but truly fulfilling. In our conclusion, I'll show you how to bring all these strategies together, avoid the most common end-of-retirement pitfalls, and make your next chapter your best yet. Over the past hour, we've covered a tremendous amount of ground together, much more than most retirees ever encounter in a single conversation or consultation. Let's pause to acknowledge what you've accomplished. You've invested your time in valuable financial education, not just entertainment, and that investment could save you thousands, potentially tens of thousands, over your retirement. The knowledge you've gained here is drawn from decades of experience helping seniors optimize their finances, avoid costly mistakes, and build lasting security for themselves and their families. In my decades of helping retirees, I've seen firsthand that the most financially secure clients are those who seek out this kind of guidance and act on it. Let's briefly recap the 8 key insights we developed throughout this series. We identified the silent but devastating impact of investment fees on retirement security, how 76% of seniors are overpaying by an average of $67,000. We exposed the hidden ways these fees erode your nest egg using real numbers and examples that make the cost impossible to ignore. We introduced the core solution, shifting to low-cost, transparent investment vehicles and fee-only fiduciary advice. We gave you a step-by-step process to uncover and reduce your fees with clear timelines and dollar amounts. We revealed the most common mistakes, like surrender charges, tax missteps, and free investment traps that cost retirees dearly. We shared advanced strategies for maximizing after-tax returns, including withdrawal sequencing, Roth conversions, and asset location. We walked through a practical 90-day implementation timeline so you can move forward confidently without missing key deadlines. We tackled real-world troubleshooting, how to handle paperwork, advisor pushback, and tax surprises, so you're never caught off guard. This isn't just information, it's decades of expertise distilled into practical, actionable guidance. What separates financially secure retirees from those who struggle isn't luck or timing, it's knowledge and implementation. The most successful clients I've worked with consistently apply these principles, review their plan annually, and never stop learning. Now that you understand each piece, here's how they work together. When you identify and eliminate unnecessary investment fees, you immediately stop the silent drain on your portfolio. Layering in tax-efficient withdrawal strategies and smart asset location, you multiply the benefits, keeping more of your money compounding year after year. Add in regular reviews and family engagement, and you create a system that not only protects your own retirement, but also strengthens your family's financial future. Let me emphasize this important point. A retiree who follows this complete approach, auditing fees, optimizing taxes, and reviewing annually, typically saves $5,000 to $10,000 or more per year on a $750,000 portfolio. Over a 20-year retirement, that's $100,000 to $200,000 in additional wealth. This is why the wealthiest retirees I advise often outperform those with larger starting balances. They avoid costly leaks and let their money work for them, not for Wall Street. This is your aha moment. These aren't complicated or risky maneuvers. They're proven, conservative steps that compound over time. After helping retirees navigate multiple market cycles, I can tell you, the difference between a good retirement and a great one is often just a handful of smart, well-timed decisions. So what should you do now? Here are your next steps, broken down into 4 clear phases you can start today and complete within the next 30 days. Step 1. Assessment phase. First week. Start by gathering these 3 essential documents: your most recent account statements for every investment, your Social Security statement, and your latest tax return. Calculate your current position by listing each account, its balance, and any visible fees. Identify your biggest opportunity area. Maybe it's a high-fee mutual fund, an old annuity, or a managed account that hasn't been reviewed in years. Step 2. Planning phase. Second week. Create your personalized timeline based on your age, goals, and when you plan to start withdrawals. Research the specific options we discussed, such as low-cost index funds, ETFs, or fee-only advisors that fit your needs. Document your current investment strategy and compare it to what you've learned here. Where are the gaps? Where could you save the most? Step 3. Professional consultation. Third week. Schedule a meeting with a qualified financial advisor, ideally a fee-only fiduciary. Bring your documents and fee summary and ask these questions. What are my total annual investment fees, including fund expenses? Are there any surrender charges or tax implications if I make changes? How can I optimize my withdrawal sequence and asset location? Verify that your advisor understands and can implement these advanced strategies. If you feel any resistance or confusion, don't hesitate to seek a second opinion. Step 4. Implementation begins. Fourth week. Start with the lowest risk, highest impact change. Often, this means moving a portion of your portfolio from high-fee to low-fee funds or consolidating old accounts. Set up any new systems or accounts needed for your optimized strategy. Begin tracking your progress with simple metrics: total fees paid, after-tax income, and annual portfolio reviews. Remember, the goal is steady, ongoing improvement, not overnight perfection. Remember, every financial strategy carries some level of risk, and your situation is unique. The goal isn't perfection, it's optimization based on your needs, priorities, and comfort level. Most successful retirees implement these changes gradually over 6 to 12 months, reviewing results along the way. Don't let perfectionism prevent you from starting. Small improvements compound into big results over time. Let me be clear, these aren't get-rich-quick schemes. They're proven, long-term strategies that have stood the test of time. Past performance never guarantees future results, and tax laws may change. This content is designed to inform your decision-making, not replace personalized advice. Always consult with qualified financial, tax, and estate planning professionals before making significant changes. As you move forward, know that you're now part of a community of informed retirees who refuse to settle for average results. The journey to financial optimization is ongoing. Markets shift, laws evolve, and your needs will change. Continue your education by staying informed about retirement planning developments, new tax rules, and investment options. Share your success stories and learn from others who are implementing these strategies. Your experience and wisdom, combined with these tools, create a powerful advantage. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps others find trustworthy information. Share your biggest takeaway in the comments below. Which strategy will you implement first? Have you already uncovered hidden fees, or do you have questions about your next steps? Your insights and questions help build a stronger, smarter retirement community. Subscribe for more in-depth retirement planning guidance that could save you thousands in the years ahead. Most importantly, take action on what you've learned. Your future self, your family, and your legacy will thank you. You've worked too hard to let hidden fees erode your security. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight, knowing you're making informed, confident decisions about your hard-earned money. You'll know you're on the right track when your financial stress decreases, your questions have clear answers, and you see your savings lasting longer than you ever imagined. The goal is progress, not perfection. Every small improvement compounds over time. Remember, this is educational content designed to empower your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified professionals before making significant changes. While this information provides a strong foundation, professional guidance is invaluable. Advisors, tax professionals, and estate planning attorneys can help you customize these strategies for your specific situation. So, what surprised you most about the strategies we covered today? Which approach best fits your current retirement needs? Have you already implemented any of these techniques, and what results have you seen? If you could ask a financial advisor one question based on this video, what would it be? Share your thoughts in the comments below. The cost of inaction often exceeds the cost of making informed decisions. You now possess knowledge that many retirees never acquire. Use it to your advantage. The sooner you start, the more your money can work for you, your loved ones, and the legacy you want to leave. Thank you for being proactive, for valuing your financial future, and for joining a community of retirees who expect more from their retirement. Here's to your independence, your security, and your peace of mind for many years to come.